These are the shocking truths about homeowners insurance that companies like Allstate and State Farm desperately don't want you to know. While you're paying record-breaking premiums, major insurers are denying claims at unprecedented rates and making record profits, all while leaving millions of homeowners financially devastated when they need coverage most. The numbers are staggering. American homeowners saw their premiums skyrocket by an average of 24% over just 3 years, according to the U.S. Treasury's most comprehensive insurance data, released in January 2025, that's an extra $648 per year for the average homeowner, pushing typical annual costs to $3,303. What's truly outrageous is that collectively, homeowners paid an estimated $27 billion more in 2024 than they did in 2021. Meanwhile, property and casualty insurers made $166.8 billion in profit in 2024. These record-high profits jumped 91% from 2023 and a staggering 330% from 2022. The industry's combined ratio dropped below 100%, meaning they're paying out less in claims and expenses than they collect in premiums. While you're struggling to afford your premium increases, insurance companies celebrated their most profitable year in history. The premium crisis is just the tip of the iceberg. What's happening behind the scenes with claims processing is far more sinister. The dirty secret of the insurance industry is their systematic approach to claim denials. Weiss Ratings found that the denial rate across the entire United States reached 37% in 2023, up 12% from just 20 years ago when it was 25%. This means more than 1 in 3 homeowners who file legitimate claims are being told no. The National Association of Insurance Commissioners' market conduct data confirms this troubling trend across all property insurance sectors. In some states, the situation is even worse. Texas leads the nation with 47% of claims closed without payment, nearly half of all claims filed. That rate has steadily climbed from 35% in 2016. Water damage claims face denial rates approaching 10%, and in some areas, insurance companies reject nearly half of all homeowners' claims. The worst offenders are companies you probably trust. Farm Bureau Property and Casualty Insurance leads with a 70.5% denial rate. USAA affiliates declined 48% of claims in 2023, while Allstate denied 46%. In Texas specifically, Lemonade and Spinnaker exceeded 60% denial rates. These aren't small fly-by-night operations. These are major insurers that millions of Americans rely on. When confronted with these statistics, insurance companies deflect responsibility. Allstate dismissed the Weiss report as inaccurate, claiming they protect their customers with fair payments. The data tells a different story. As Dr. Martin Weiss, CEO of Weiss Ratings, points out, insurance company executives often blame their customers for filing fraudulent claims or complain that states don't approve big enough rate increases. However, they can't explain why the abuses have increased so markedly over the years. The geographic impact reveals how climate change has become a convenient excuse for corporate greed. Florida homeowners face the highest premiums in the nation at $7,136 annually, with projections showing another 9% increase in 2025, reaching $15,460. Between 2019 and 2024, Florida rates rose 42.5%. Many Florida homeowners also face separate hurricane deductibles of 2 to 5% of their home's insured value, creating additional out-of-pocket costs that can reach tens of thousands of dollars. California isn't far behind, with wildfire-prone areas seeing similar devastation. What insurance companies won't tell you about geographic pricing is that credit scores can impact premiums more than actual climate risk. In Florida, where credit scoring is allowed, homeowners with low credit scores pay nearly $2,000 more annually than identical neighbors with high credit scores. California prohibits this practice, proving it's a choice, not a necessity. Wind mitigation inspections can provide significant discounts in hurricane-prone areas, yet many insurers fail to adequately inform customers about these cost-saving opportunities. The non-renewal crisis represents another layer of deception. In Florida, 3.35% of homeowners with active policies were dropped by their carriers in 2024, often immediately after filing storm damage claims. Just 6 years earlier, this rate was under 2%. California saw 3.18% non-renewals, nearly quadrupling from 2018. Louisiana experienced the most dramatic jump, from 0.55% in 2018 to nearly 3% in 2024, more than a five-fold increase. Dr. Martin Weiss calls these numbers shocking, noting that you'd think insurance companies would want to keep their customers. Telling them to go away in much larger numbers is bad for the company's current business, bad for their future growth, and terrible for homeowners who often have no viable alternative. The underinsurance trap is the most devastating secret of all. Around 60% of homeowners are underinsured, with the average home underinsured by 22%. Luxury homes are often underinsured by 60% or more. When the Marshall Fire devastated Colorado, 74% of affected homeowners were underinsured, and 36% were so severely underinsured their policies covered less than 75% of rebuild costs. This isn't accidental. Many policies include co-insurance penalties that kick in when you're underinsured by a certain percentage. Most require you to insure your home to at least 80% of replacement cost. If you fall short, the insurance company applies a co-insurance penalty that reduces your claim payment. You don't just get less money because your coverage is too low, you get penalized on top of that. Understanding the difference between actual cash value versus replacement cost coverage is critical to avoiding this trap. The claims process itself is rigged against homeowners. Insurance companies deliberately use flawed estimation software that undercalculates repair costs, leading to lowball offers. Adjusters perform brief surface-level inspections. Companies stall claims to make policyholders desperate and willing to accept smaller settlements. They deny claims without valid reasons by wrongfully interpreting policy exclusions. Filing even one claim triggers a 32% average premium increase, according to insurancequotes.com. You can expect rate increases of 9% to 20% per claim, and these surcharges stick with you for 5 to 7 years. Claims on your property from previous owners can also affect your premiums, meaning you're paying for someone else's claims history. The exclusions game reveals how policies are designed to collect premiums while avoiding payouts. Standard homeowners insurance excludes floods, earthquakes, termites, mold, normal wear and tear, sewer backup, pest damage, certain dog breeds, home business activities, high-value items above specific limits, and building code upgrades. Many homeowners discover these exclusions only when filing claims. Your dwelling coverage, also known as Coverage A, may seem comprehensive but comes with numerous hidden limitations. Even when you have coverage, companies employ bad faith practices including lowball settlements, payment delays, disputing coverage, and requiring unnecessary documentation or repeated inspections. A recent ProPublica investigation found that Citizens Property in Florida wins over 90% of disputed claims in a mandatory arbitration process it helps fund, leaving homeowners with virtually no recourse. The regulatory capture problem means the agencies supposed to protect you are often influenced by industry lobbying. Some states are fighting back, though. California Insurance Commissioner Ricardo Lara opened a formal market conduct investigation into State Farm's post-wildfire claims handling, citing communication breakdowns and unfair treatment of policyholders. The hidden database they use against you is called the Comprehensive Loss Underwriting Exchange, or CLUE. This database tracks every claim filed on your property, even by previous owners, and insurance companies use it to set your rates. Errors in CLUE reports can make your policy more expensive, and most homeowners don't even know it exists. AM. Best ratings and other financial strength indicators are readily available to consumers, yet insurers rarely emphasize the importance of choosing financially stable companies. Executive compensation reveals the industry's true priorities. A Consumer Federation of America study found that CEO compensation at 10 major property insurers jumped 27% from 2023 to 2024, the same year they raised homeowners insurance rates by double digits. The Tampa Bay Times and Miami Herald revealed that several Florida insurers reported losses to regulators while executives funneled billions to affiliate companies, using fabricated losses to push anti-consumer legislation. The real estate market impact is already visible. Florida State University researchers found that a 10% increase in homeowners insurance costs reduces housing prices by 4.6%. Since 2018, rising premiums have reduced home values by $20,500 in the most exposed areas and by $43,900 in the top 10% of high-risk properties. In California, 13% of realtors reported sales falling through because buyers couldn't secure homeowners insurance, nearly double the previous year's rate. State insurers of last resort are buckling under pressure. Florida's Citizens Property covered nearly 772,000 policies as of September 2025, while California's Fair Plan had $529 billion in exposure as of December 2024, up 217% from September 2021. Texas Windstorm Insurance Association faces similar pressures in coastal areas. These government-backed insurers were never designed to handle such massive exposure. High-risk properties often turn to surplus lines insurance when standard markets won't provide coverage. What can you do to protect yourself? First, understand that shopping for insurance requires comparing policies with identical coverage limits and deductibles. Don't fall into the trap of choosing lower premiums with inadequate coverage. Review your policy annually and ask your agent how replacement cost was calculated. Consider extended replacement cost coverage, which provides additional protection above your dwelling limit. If you have $400,000 coverage with a 50% extended rider, you actually have $600,000 in protection. This coverage can absorb inflation spikes and demand surges after disasters. Before filing small claims, compare repair costs with your deductible and consider the long-term premium impact. If damage is minor and close to your deductible amount, paying out of pocket may save money over time. Know your rights under state insurance laws. In Texas, if you can prove your insurer knowingly violated insurance codes, you could collect up to 3 times your actual damages. Document everything, take photos, keep records, and don't accept the first settlement offer without careful review. Request your clue report annually to check for errors. If you find mistakes, dispute them immediately. Consider working with public adjusters who can help navigate complex claims, though be aware they typically take 10 to 15% of your settlement. The homeowners insurance industry has become a rigged game where companies collect massive premiums while systematically avoiding payouts. They've weaponized climate change to justify rate increases while denying climate-related claims. They've created a system where filing legitimate claims makes you a target for non-renewal or premium punishment. The $27 billion in additional premiums paid by homeowners over 3 years didn't go toward better coverage or faster claims processing. It went toward record profits and executive bonuses. Meanwhile, denial rates continue climbing, and millions of homeowners remain dangerously underinsured. This crisis demands immediate regulatory reform, including caps on denial rates, mandatory arbitration reform, transparency in claims processing, and protection against retaliatory non-renewals. Until then, homeowners must navigate this predatory system armed with knowledge and vigilance. The insurance industry's business model has shifted from protecting homeowners to extracting maximum profit while providing minimum coverage. They're counting on your ignorance of these practices to continue this exploitation. Now that you know the truth, you can make informed decisions and demand better. The brutal reality is that in today's insurance market, the companies supposed to protect you are often your biggest financial threat.